This conference will now be recorded.
Okay, the purpose of our meeting today is to review the Period 3 exam. The Period 3 exam consists of 3 parts. First of all, a cost volume profit problem where you will have to determine the quantity for the target loss, break even target income of $1 million, target income of $2 million. The second requirement is to determine the selling price of 4 books where we have multiple books being made, and you need to determine the selling price based on the unit cost of all 4 books, as well as the predetermined overhead rate. Finally, we have a process costing problem where you will be required to calculate the amount of cost that will be transferred from one process to the next. Any questions? Okay. So let's move to the first problem, which is determining the quantity that's going to be required to lose 100,000, break even, earn $1 million, earn $2 million. And then once we determine that, we're going to place those numbers in this area to prove that those net incomes were met by the quantity. So that's how we'll go. Our starting point is to calculate selling price, variable costs, adding up lines 3 through 7 to get the total variable cost, calculating the contribution margin, then coming up with the total fixed cost. So that's the first thing that we're going to do. And so as we look at the problem, we see that our book requires 2 reams of paper at $5 each. And therefore, the paper cost is going to be $10. Then we are required to have 2 ink cartridges at $10 each. So the ink cartridge cost is $20. Finally, we're told that we pay at the rate of $20 an hour for 4 books per hour. So therefore, since we can make 4 books an hour, we're going to divide 4 into 20. And so our labor cost is 5. In some situations, we can have bad debts and other selling expenses, but for this problem, we're simply using as variable costs just the ink, the paper, and the labor. And so when we add those 3 together, we get $35 as the total cost, total variable cost. We now need to determine the selling price. The unit selling price is 3 times the unit variable cost. So if our variable cost is 35, then 3 times that gives us a selling price of 105. Next, we calculate our contribution margin, and the contribution margin is simply line 1, the selling price, minus line 8, total variable cost. So I'm adding this to the template. So if we subtract selling price from the total variable cost, then we come up with a contribution margin of 70. So we've determined selling price, we've determined total variable cost, and we have contribution margin. Simply looking at the preliminary assumptions given to us. Next, we have to calculate the total fixed cost. And we're told that the overhead is 90, the fixed expenses are 40, and the interest expense is 10,000. So now we will bring those costs down. And I'm gonna see if I can, no, it's not gonna copy, so I better put them down. So the manufacturing overhead was 90,000. The administrative expense was 40,000. And the interest expense was 10,000. And therefore, our total fixed cost is going to be lines 11 through 13. When we add those up, we get 140,000, 140,000. Now that we have the selling price, and we have the contribution margin, and we have the total fixed cost, now we can work to determine our quantities. We'll look at break-even quantity first, and that formula is fixed cost divided by the UCM. And so our UCM, and let me just put this in here, contribution margin, which we define as the UCM is 70. So when we work with the break-even quantity, fixed cost minus unit contribution margin for the break-even quantity. So total fixed cost is 140. That's going to be the numerator in our calculation. The divider is 70, the contribution margin, and that's always going to be the case. Our divider is always the UCM. So if we divide 140,000 by 70,000, we come up with the quantity required to lose 100,000 to break even is 2,000. And I'm going to come in here and insert a row below. And I'm going to call this the quantity row. So we're putting our quantities here. Get everything here. Okay. So the quantity to break even, we've just calculated that. Is $2,000. So for some reason, Word likes to do that. So that quantity is $2,000. So the quantity here is going to be 2,000 to break even. So we bring the 2,000 in here. Now, so that's the quantity. Now I'm going to go and work with 1 unit if we only sold 1 book and put that basic information in. So if we sold 1 book, selling price would be 105. The total variable cost, and we'll just put in the total unit variable cost at 35, which is from here. So our unit contribution margin, the cost of selling 1 item is 70. So our fixed cost, 140,000. And that fixed cost is going to stay the same all the way across. So we can copy it, paste it in, and we got the 140,000 in there for the fixed cost. So if we sold only 1 item, we would make $70, but we would have 140,000 in fixed costs, and therefore our net loss on selling just 1 item is $139,930. So we would have a loss. So what this is showing us is that we got to get a bunch more sold just to cover fixed costs. So 1 item just covers, so that's what the contribution margin is about. How much do we make above cost, $70, to cover fixed costs and eventually make a profit? Now, let's look at the break even. We have 2,000, and what we're going to do is to multiply 2,000 times the selling price, 105. And if we do that, we're going to get $210,000 as our total selling price. Then we're going to take the 2,000 and multiply times the variable cost, 35, and we're going to get 70,000 as our total variable cost. Subtracting the 70 from the 210, we get a contribution margin in total dollars of 140,000. Our fixed cost is 140,000, and therefore our net income is 0. And so that's what we wanted to be able to show. We wanted to be able to show that if we sold 2,000 units, we pick up enough contribution margin on those 2,000 units. 70 times 2,000 gives you 140. So you can see that, a shortcut method of proving this would have been just to multiply the 70 times the 2,000, and that would give us the 140. So 2,070 gives us a 140. We have now covered our fixed costs, and so our company can break even. Let's look at our second situation, which is a target loss. So we go in here, target loss of 100,000. The target loss formula is fixed cost plus the target loss divided by the UCM. So it's 140,000 minus 100,000 divided by the UCM of 70. We're always divided by that UCM. And so our quantity would be 571.4. Now we're going to multiply 105 times 571.4, and that's going to give us 50,997 as we try to move now to a net loss of 100,000. Our variable cost, we're going to multiply 35 times the 571.4, and that's going to give us total variable cost of 19,999. We subtract 19,999 from the 59,997, and our contribution margin in dollars is now 39,998. And so our loss is going to be, and because of rounding, we'll lose some, it won't be exact, but just so we then fit that all this up. So our loss is 100,000, comma 002. So with $2 there. So here then we work the second one out. So 571.4 becomes the amount. Let me just see if I can delete some of these. 571.4 becomes the amount to lose. Let's delete these. Okay, let's move on to the quantity required to earn $1 million. And we're going to go to our target profit formula now, which says that fixed cost plus the target profit divided by the UCM will give us the quantity that we need to make $1 million. So it's 140,000 plus 1 million divided by 70,000. And so if we make that calculation, we should end up with 16,285.7. So once again, for a target profit, we add that to the fixed cost, 140 plus 1 million, divide by that common divider, the UCM $70. And so we make that calculation. The approximate amount will be 16,285.7. 16,285.7. Okay, so let's then run these calculations through and let's look at how we end up. So let me see if I can get my calculator here. And I'm going to take the 16,285.7 times the 105. And that's going to be approximately 1 million. Clear it out too quickly. 16,285.7 times the 105 selling price. That's going to give us approximately 1,709,000 999 as our revenue. For our costs, we got to do a similar thing. We got to multiply the 16,285.7 times this 30 variable cost, 35. And we're going to come up with the total variable cost is 56. I guess about 57,000. So let's just make it 57,000. And so when we have the 1,709,999 revenue minus I think this should be 570,000. So this should be 570. This is going to give us a contribution margin of look like I've done something wrong here. So I'm going to have to, let's see if I can correct this right quick. I need 16,285.7 times 35. That's going to be 570,104. So this should be 570,104. And now let's see if we can make the subtraction. 1,709,999 minus 57,570, 104. That's going to give us 1,139,985 as our contribution margin. So when we subtract the fixed costs, we come up with a target income of 999, 895. So rounding, put it in the right place. Rounding causes us to be off. So we won't exactly get there because of rounding. But as long as you would then $50 to $100 will be okay. And this is something you're going to see on your projects too. So we have the targets of where we want to be. And you just have to be close to within $50 or so. Now, the target income of $2 million, I'm going to let you do the work on that one on yourself. You're simply going to go and plug in this formula. It's all laid out here for to divide by that, and then you're going to go through and prove it and see if you're close to 2 million. Okay, let's move to the second problem that you'll be required to do, which is a problem on joint product costing. We're making 4 books: Principles, Intermediate, Advanced, and Tax. And here are our assumptions, our quantities: 20, 20, 10, and 10. Ink for each book, paper for each book, labor productivity, and the labor rate, which is $40 an hour. And then here are our selling price multiples. So the first thing we have to do is come up with the labor hours that are going to be involved. And so to get the labor hour, we simply are going to divide the labor productivity line into the quantity line. So 20 books per hour into 20,000 gives us, on the Principles book, 1,000 labor hours. On the Intermediate book, 10 books per hour, we're making 20,000, so 2,000 becomes the labor hours for the Intermediate. Advanced, we're making 10,000 books, it's 10 books per hour, so 1,000 becomes the total hours that are going to be required. And for the tax book, we only make 5 books per hour. We're making 10,000, so it's going to take 2,000 hours. And when we add all of these up, 2 plus 2, 4, we get 6,000 hours. So our total hours is 6,000. The total overhead that we're allocating is 300,000. And so our goal here is to determine how much of the 300,000 is going to be allocated to each book. So that's what we're doing at this stage. To get to that stage, we're going to bring down these hours. And we're going to paste them right in here. So 1,000, 2,000, 6,000 total hours. Our activity rate is always going to be the total overhead divided by the total hours. 300,000 divided by 6,000. And if we divide 300 by 6,000, we should get an activity rate of $50. Now, once we get that activity rate, we bring our hours down for the books. And we pasting those hours in. Then we're going to get our activity rate, which is $50. And we paste that in for all the books. Now to allocate the overhead, and we have to come up with a total of 300,000. We simply multiply the labor hours times the activity rate. Line 1 times line 2. And so for the principal's book, it's going to get 50,000 of labor hours. The intermediate book is going to get 50 times 2,000. It's going to get 100,000 labor hours. The advanced book is going to get, put this 100,000 back. It's going to get 50 times 1,000. It's going to get 50,000. And let me move these lines over some. And finally, our tax book is going to get 2,000 times 50, or it's going to get 100,000 also. So you see that we've allocated the overhead to each book based on the activity rate, which we calculated here. So this is a weighted average of 50. So the overhead is being allocated at that rate. Now we go up here and get our quantities that we're making. So I'm going to drag quantities. Let me undo that. Okay, so we got our quantities where we need them now. And so now we need to come up with a unit overhead cost per book. We need the unit overhead cost per book. So we simply divide line 3 by line 4. We're making 50,000 principals books. The quantity is 20. So the price per book, is going to be $2.50. We're going to do a similar thing for intermediate. 100,000 divided by 20,000, and we make that division, that's going to give us $5 per book. Next, we look at the advanced book, 50,000 divided by 10, so it also is going to be $5. And then for the textbook, 100,000 divided by 10,000, it's going to be $10,000, $10 per book. Okay, so now we have the unit overhead cost per book. We calculated an activity rate, we multiplied it times the labor hours to get the total overhead allocated. Then we divided by the quantity we are making, so we will come up with the unit overhead cost. So now that we have the unit overhead cost, we're ready to come in here and come up get the total unit cost. And the total unit cost is simply, we're going to copy our overhead numbers down. We're going to copy them. So now we have the unit overhead cost. Now we got to put in ink, paper, and labor for each one, and then multiply by the selling price multiple. So let's just get these selling price multiples and pull those down. Okay, so we have our selling price multiples in now. And so let's see if we can determine the selling price of the principal's book. We go back up here to the assumptions. The principal's book had one ink cartridge at $10 each. So we're going to put in the $10 for the ink cartridge. The paper was $1 at 5. So we're going to put in the 5 for the paper. The labor was 20 books per hour. So we're going to divide 20 into 40, and we're going to get $2 as the labor cost. And so remember, when we get the unit labor cost, if we can make more than one item in an hour, we divide. And so our total unit cost, 10, 5, 17, 19.50. Our selling price multiple was 4. And so therefore, the selling price is 78. So unit cost is 19.50, selling price is 78. Predetermined overhead rate is going to be 50. And that's for every book. So, so we use a weighted average approach to get that. So we got all of these done. Okay. I'm going to let you complete this chart. If you agree with me, your answer should be 156 for the intermediate book, 98 for the textbook, for the advanced book, excuse me, and 156 for tax. So go ahead and complete this chart and make sure you can get those answers. Okay, any questions?
This conference will now be recorded.
Okay, so the final problem we'll have on the exam is a process costing exam. Remember, in process costing, we have the situation where there's 2 or more sites where work is being done. And of course, the great example would be here in Houston, where in the Gulf, oil is extracted from the ocean bottom. Then it's brought into Houston and refined into gasoline and all the other byproducts. So it's two processes, one process in the Gulf and another process here in Houston. And so we create separate cost sites for each area so we can control the cost sites by area. And then we transfer the cost from one working process to the next. So you have, whereas with multiple products, we have a working process for each product. We're only dealing with one product now, but their working process accounts for each process. So let's look at our problem. It says we had scheduled for production 12,000 units. The raw materials purchased is 400,000. The raw materials used are 330,000. The direct labor that we incurred was 272,500. The applied manufacturing overhead is 200,000. We transferred to work in process to 10,000 units. So we started 12, we completed 10,000. The ones that were left behind were 2,000 units, 50% complete for raw materials and 25% complete for conversion costs. What is the journal entry required to transfer from work in process 1 what's the journal entry required to go from work in process 2 from work in process 1? So that's the requirement. Let's come up with the amounts that are going to be in this journal entry. So how do we do this? We have this table that's a template exactly on what we're going to do, and it leads us to the answer. So the units scheduled for production were 12,000. And of course, the key thing is we're going to transfer different amounts for raw materials and conversion costs. Conversion costs, of course, are your work in process and your direct labor. They convert the raw materials into the finished product. The units completed were 10,000. The percentage completed was 50% for raw materials for the units that were left, but only 25% for labor, the conversion costs, labor and overhead. So our partially equivalent units, jump too fast. So I left out the partial completed. The percentage completed is 50%. And so partially equivalent units, we simply multiply this percentage on line 4 times the quantity on line 3. So this is simply line 2 times line 3. So the partially completed equivalent units, line 2 times line 3. So that's going to be 1,000 for the raw materials, 500 for the conversion costs. Total equivalent units, we add line 1 and line 4. So this is 10,000 plus 1,000, we get 11,000. For direct materials, and then for the conversion costs, we get 10,000 plus 500, or 10,500. Now we got to get the total cost in the work in process account. For raw materials, it's not the cost was purchased, but it's what was transferred in, which is 330,000. For our conversion cost, labor and overhead is 272,500 plus 200,000, or 472,500. So what we got to determine is how much of these costs are going to be transferred out to the next unit for that journal entry, for this journal entry. So the cost per equivalent unit, another weighted average calculation, we're going to divide the total cost on line 6 by the quantity on line 5. And so we come up with a cost per equivalent unit of $30 for direct materials. And for the conversion cost, we come up with $45. We just simply divided line 6 by line 5. The units transferred, that's going to be these units that were completed. I'm going to drag them down for you. Copy, paste. Okay. So the cost transferred is simply line 7 unit cost times line 8, the quantity. So these are dollar amounts here, of course. So we multiply 10,000 times 30 and we get 300,000. Then we multiply 45 times 10,000 and we get 450,000. Therefore, the total cost transferred, 300 plus 450, are 750,000. So we're transferring out 750,000. So in this journal entry, the journal entry that we're going to make, we're going to debit work in process 2 for 750,000, and we're going to credit work in process 1 for 750,000. So what we've determined of those total costs that we had, we transferred out 750. So we had 330 and 472. So it's a little bit over $1 million in the account, but we only transferred out 750,000. I guess we had about a little over 800 in the account, a little over 800,000 in the account, and we transferred out 750,000. So these are the 3 parts of the test, and so you see examples of how the problems are set up. They'll be set up the same way. I'll put these little charts in for you. So So you won't have to strain as much, even though you're supposed to memorize these formulas. This table will be there, numbers change. Then you have to come through and determine the selling price for each book. And finally, process costing, where you determine how much is going to be transferred. So hopefully this information will be useful and helpful as you prepare for exam 3. Thank you.